in the state of Michigan, but I can do work across the country. I have 10 years of experience in finance and accounting. I am the CEO of P&P CPA, and I specialize in business accounting, tax, and consulting. All right. So the new tax laws are, we have a new president, and his agenda was creating laws that definitely benefited business owners. All right. And so with these tax cuts that have been implemented, over $130 billion in income is going to come and flow through the hotel and related industries. Also additional spending in the restaurants and stores and the travel destinations, which also will have a lot of owners doing more hotel investments. So I'm going to talk about some tax terms, and if you don't know what they are, please don't hesitate to stop me or ask me about them. But the 1031 exchange is essentially for hotel owners who sell a property and then buy a similar property, okay? And so there is an opportunity to defer the taxes. So if you own a hotel and you sell it, and you have a certain amount of time to buy a similar property, and then you do not have to pay the capital gains on that property, right? You'll have to pay them eventually. You don't have to pay them that year. Section 179 is referring to write-offs for equipment. So a lot of items that go into a hotel last longer than a year. And things that last longer than a year have to be depreciated over the time that it would take for you to use that item. So if you had furniture, it may be depreciated over 5 years, right? But with Section 179, up to $1 million of property, furniture can be expensed right away, right? That phases out dollar for dollar for total asset purchases of $2.5 million, right? There are certain improvements that qualify. Real estate itself does not qualify, but a lot of improvements to hotels would qualify for this. Segregation studies, which basically separate out different equipment that go into a hotel, air conditioning systems, electrical systems, those you might be able to do a Section 179 write-off, even though it's a part of the construction of an actual building. All right, another way to write off long-term assets is called bonus depreciation. Now, the change with this allows to claim 100% of bonus depreciation. In the past, it was 50%, and this is going to be for limited to just the new builds, so new construction. These new rules are in place until the beginning of 2022, so investors should take advantage now. And under the old law, qualified improvement property was depreciated over 39 years, all right? But now only was eligible for 50% bonus depreciation. So a non-residential property, it took 40 years for you to depreciate the entire asset. But with this new law, you'll be able to find ways to take that and expense that right away and save on the taxes. The new law states that only items with depreciable recovery period of 20 years or less are eligible for 100% bonus depreciation. All right. Again, these are fixed assets that are in place as of September 27, 2017. The bonus depreciation is not contingent upon whether the taxpayer has taxable income. So what that means is if you have a loss, you can still take bonus depreciation. There is a limit on what we talked about before, the Section 179, there's a limit if you have a loss. But if you are taking losses, you can continue to get tax benefits from the bonus depreciation. Right? The new Tax Act also expands bonus depreciation for fixed assets placed in service that are both new or used. So if you buy a used piece of machinery or buy used furniture, you can still get bonus depreciation. 22 million for couples. All right. So under the old rules, if the owner of 2 hotels valued at a total of $10 million died, their family members would have to sell one of the properties just to pay the required taxes. Basically saying that a $5 million, they would owe $5 million in taxes in the transition under the old estate tax laws. All right. Business interest expense. So a lot of hotels have financing. All right. So your interest expense will be limited for business owners with annual gross receipts of $25 million or more over a 3-year average. So if you're averaging $25 million a year for 3 years, then you can take advantage. Bonus interest is defined as any interest expense paid or accrued on any indebtedness that is tied to the taxpayer's trade or business. So this is credit card debt, mortgage loans, any type of debt for the business that has to do with running the hotel. Right? The deduction for business interest expense is limited to the sum of 30% of the entity's taxable income. So if, for example, you have $100,000 of taxable income, then it's limited to $30,000. Right? Any interest expense that is disallowed can be carried forward up to 5 years. So if you had more than $30,000 worth of debt, let's say you had $100,000 worth of interest, then over the next 5 years, you can continue to deduct that interest from your taxable income. All right? And interest expense which may have provided a substantial tax deduction in years past may not have the same current year's benefit. Just saying that older interest, you can't use that. It will have to be new interest. All right? Also, loss limitations. Any losses in excess of $500,000 for married taxpayers or $250,000 for single fathers are not deductible in the current year and will be carried forward to future tax years. Right? This is particularly talking to companies that pass through their taxable income. So this is not for corporations. Right? This would be for a S corporation, partnership, or sole proprietorship. It's not uncommon for hotel owners to obtain substantial tax deductions when a build-out is completed and placed in service. All right. Again, when we talk about the bonus depreciation and the 179, we're talking about millions and millions of dollars of expenses, but you have limits, okay? And then those limits will be carried forward for future tax years. So having a tax plan, you can start to make decisions based on how much you're going to be spending in the current year and what your plan is in the future. The new tax law now imposes a limitation on excess business losses from active trade or business, which could defer the owner's tax benefit of the build-out. Basically, saying that there's limits for a reason. The IRS doesn't want people going crazy and spending $3-4 million on new build-outs without paying some sort of tax, so they're limiting the tax losses. All right. Another big thing that I get a lot of questions about is the pass-through changes. How many people in here understand or know if they're a pass-through entity? Okay. And then how many people are corporations? All right. So pass-through, and if you are a corporation, you could also be an S corporation, which falls under pass-through. All right. So effective at the beginning of this year, flow-through income from a partnership, a limited liability company, or S corporation, or sole proprietorship may deduct 20% of qualified business income. So if at the end your taxable income is $100,000, 20% of that is not taxed at all. Okay? So there's only going to be taxed on $80,000. As long as the deduction is not capital limited, the effective top tax rate that business owners would pay on their flow-through or self-employed income is 29.6%. Right? 37% was the top rate. So it's 37% times 1 minus 20%. Basically saying that because $20,000 is not being deducted at all, or not being taxed at all, the most you're going to pay is 29.6, even though the tax rate is 37%. All right. So these are the limitations For the 20% deduction, for the pass-through entities, 50% of the W-2 wages paid with respect to the business, excluding guaranteed payments to partners. Right, so 50% of what you pay your employees, or 25% of the W-2 wages paid, plus 2.5% of the cost of tangible depreciable property that's used in the production of qualified business income. Tangible depreciable property is going to be furniture, it's going to be the actual building, beds, all the different things that go into that are fixed assets, long-term assets. A business owner is allowed to take full advantage of the 20% deduction, regardless of their W-2 wages, if their taxable income is only $315,000. So if your taxable income is $315,000 and you're married, filing jointly, then the 50% W-2 and the 25% W-2 do not apply. All right? And so the qualified income business deduction phases out between $315,000 and $415,000 if you're married filing jointly, and then it fades out for single persons at $157,500. All right. Again, this is for pass-through entities. All right. So 21% for tax years beginning after December 31st, 2017. The C corporation tax rate is a flat 21%. There are no brackets for C corporations. The range used to go from 25% to 39%. Again, for C corporations, it is just a flat 21%. Business owners initial reaction usually is, should I be an S corp or should I be a C corp? Should I be pass through or should I be a C corporation? Since the number says 21%, right? So you see a 21% tax rate for C corporations, but a 29.6% for flow through. All right. So what I've set up here is kind of an example of two similar companies with the same amount of taxable income. So I'll go through the pass-through first. Pass-through being your S corp, your LLC, partnership, or sole proprietorship. So 60,000 out of the 300,000 will not be taxed at all. All right. So your taxable income after deduction is $240,000. So then, at an individual rate, married filing jointly, that's 24%. So your actual tax that you're paying on the $240,000 is $57,600, which basically is an effective tax rate of 19.2%. Now, for a C corporation, taxable income is $300,000. Your corporate tax rate is 21%, which is $63,000. All right. Your net corporate income is $237,000. All right. Now, if you leave the money in the corporation, then all you're going to be taxed on is the $63,000. But if that money goes to an owner, the owner has to pay taxes again. All right. On the individual level, married filing joint, that tax rate is 18.8%. So they're paying another $44,556 in tax for a total amount of $107,556 on an effective tax rate of 35.8%. Okay. Now, everybody's situation is going to be different because everybody's on different income levels. All right. So what you have to understand is what income level you expect to be at the end of 2018 to really understand should you continue to be a C corp, should you move to pass through, or vice versa. So just to recap, the tax cuts will have a significant economic impact on the hotel industry. There are the 1031 exchange-like kind transactions which create tax deferrals, which basically push off those capital gains if you sell a hotel and buy a new one within the IRS regulation. All right. Immediate depreciation through Section 179 and bonus depreciation rules. Also, those are going to be deferring your taxes to a later date. So you take a higher expense today in order to save on taxes today. All right. The state tax laws. So the amounts are doubled for single people as well as married filing jointly, so that you can pass on
that date, what is your timeline to purchase another property?
Yeah, so the timeline is 180 days, but it all depends on when you close the first deal and when you close the second deal. So you have to have a strategy, right? When you close your first, when you sell the first property and pick up the second. And in some cases, you may have to buy the first property before you even close the second. But it's 180 days.
So is there an extension or?
No, there is no extension. It's 100 days to close the deal.
If you can't find within that time?
If you can't find it within that timeline, then you will be subject to the capital gains tax.
What are the benefits of having a C Corp versus S Corp? I know the double taxation on a C Corp versus S Corp, but what are the other benefits of having a C Corp?
I mean, again, the benefit is that you're paying 21% rate. When I went through and talked about the pass-through, there was a lot of limitations on that 20% deduction. So, depending on how high your income, the higher your income, then you probably should stick with C Corp. So if your income is less than $500,000, you're probably in that space where you need to look at everything and make a decision. But if you're doing more than $500,000 in income, so not revenue, I'm talking about after you pay all your expenses, if you're looking at 7 figures, then a C Corp is probably the best move because of the 21% rate. And that's flat across the board. Alright? Another thing to think about with the C Corp is if the money's going to stay in the company versus paying out dividends to the owners. When you're paying out dividends to the owners, then they're responsible for the taxes on their individual return. So if you have a lot of debt in a C Corp and you're just going to be paying off debt with that extra money, then a C Corp is definitely a better way to go. Now with the pass-through, you have that benefit of that 20% deduction as long as your income is under $315 and you're married. The other good thing about a pass-through S Corp versus just having a partnership or anything like that is making sure that you're not paying too much in self-employment tax. So you make yourself an employee, you get yourself a W-2, pay your self-employment tax with that, and then you're not going to be taxed self-employment on the remaining amount of money that you've made under the S Corp or the LLC. Yes?
Is there any tax benefits for women minority owners?
She said, is there any tax benefits for women minority owners? There are no IRS rules for for people of color or for people that are underrepresented, but there may be in your area, you may be able to talk with somebody about certain grant money or things of that nature. But specifically for tax, there are no specific benefits, at least not under the income tax.
Can you explain more in detail about debt tax?
The debt? So what the new law has done is just increase the amount of money that can be passed on without being taxed at all. I think a lot of people who were supporting this tax change are people with high net worth, and so they just want to be able to pass on more money and not have to pay pay a higher estate tax. But it's just a change in the amount that you can pass on during the year.
And how much you were allowed to give a gift to your spouse or kids?
A gift? So
Per year.
I mean, you can get away with giving your spouse any amount as a gift and not being responsible for any tax. Children is where the line starts to blur. That amount is between $14,500 and $15,000 as far as just giving anyone an amount of money during the year. So for a year, it's $14,500, or it's $15,000. It's around that. It's around that area. Anything above that amount, the giver pays tax, not the person getting the money.
So if I heard correctly, for the spouse, I can give any amount.
Yes.
So before I die, I can.
Because to the IRS, you're one person. That's the way the IRS works. You guys are one person. So like, if you and your spouse own the hotel, only one person owns the hotel. You're a single owner. So it's not a partnership. It's a single owner. And the same with exchanging money. So if you give your spouse money, that there's no limit. It's like giving yourself money to the IRS. I know you may not feel like that. The IRS. Yes.
Clarify more on the depreciation.
Okay, I'll go back. So he asked, can I explain more about depreciation? So I'll start with the section 179. So this law has been in place for more than 20 years. It's just that every year they act like they're not going to do it, and then at the last minute they continue to do it. So, and the reason why is because it's a great way to get people to invest more money into their businesses, which in turn creates more economic opportunity and more money for the IRS to tax. So, if, for example, let's say that you put in $300,000 worth of furniture into a hotel, okay? Under section 179, that furniture would qualify because it's less than $1 million, and as long as it's less than $1 million, so you could take that whole $300,000 and expense it that year against your revenues. That same year, that whole $300,000. You could also use bonus depreciation, right? And that's 100%. It used to be 50%. It's 100% for 2018, all right? And that's gonna, and that's in place until 2022, all right? Again, they say that they might get rid of it, but if it goes well, they'll continue to do the 100% bonus past 2022. But with the bonus depreciation, you can do 100%, that whole $300,000 against your taxable income. What your tax professional is going to do is make sure that you meet the limits for either the 179 or the bonus depreciation. The big difference with the bonus depreciation is that it's not contingent on your taxable income. So you can have a loss. So you could just make $100,000 before we take the bonus depreciation. We do the entire $300,000 expense, and so you'll be at a loss of $200,000, and that can be applied to your future years when you do make money. And you will not pay any taxes until you hit at least $200,000 positive. And that's under the bonus. With 179, you cannot take a loss. So 179 stops at $0. So if that same 100,000, it only goes down, you can only take bonus depreciation on 100,000 for that year, and then it would carry forward over the next year. The big thing to think about here is how involved the owner is with the business, and do they have other businesses that are making money. So basically, if I want to take a $200,000 loss in 2018 from my hotel, but I got this other business that I'm involved in over here that made $300,000, well, now you're only paying taxes on $100,000 because the $200,000 loss against the $300,000 gain. All right. So everybody's situation is different. Every person, every owner, every business. Any more questions?
If you want to create a brand name, like example, Ford Motor Company, they have a name for a corporation, and they do business worldwide and within the United States. So every other state they have plans for employee. How do you create the brand? And just like if I want to get Viva Hospitality, hi Lillian, and one could have that name recognized. So if anybody see Viva Development or that is the main company, but then investor that you buy projects, develop projects in different states, and creating new entity, but your first development company is your main company that you are trying to get the word throughout the country or throughout the world. How do you do that?
Okay, so I'm going to try to repeat the question. So he said if you're creating a brand and you're going, from state to state, and people are using your brand in order to run a business as well. So I think what you're asking me is, how do you figure out how much money you're putting towards building your brand? And so the tax strategy there is going to be really based on, when you want to take the expense on the brand. Flat out, it's always expensive right away. That would be my first suggestion, is any money you spend on a brand, that's advertising. That's an advertising expense, okay? But if somebody comes to you and they say, I'm going to give you $50,000 to use your name, okay? Then your name becomes an asset. You understand? So now, I take that $50,000 of revenue and I can say, well, actually, that's how much your name is worth. That's how much your name is worth because they gave you $50,000 for your name. Does that make sense?
That's a franchise.
Yeah, it's a brand. Yeah, they're giving you $50,000 for your name, not for your building, not for software that you created, but just for your name. Can I use your name? Yeah. How much are you gonna pay me? I'm gonna give you a check for $50,000. Now you have a value, and I can assign a value to your name on the balance sheet, and then we can amortize that $50,000 over the time that that person is going to amortize $50,000. The person that owns it is going to pay taxes on the $50,000 revenue, but the person that bought the name, that's an intangible asset, and I'm going to amortize that over 180 months.
I think his question is kind of vague, it's like different. It's saying like if he starts a corporation in say Michigan, right, and he's expanding to different states, which is at taking and having investments and creating businesses in different states, how does the tax law change state to state? Not necessarily building a brand. We usually talk about creating a brand in one state and then expanding it to different states. How does that relate to tax benefits? Same thing what you're talking about.
Okay, so federally, that's covering everything. So the IRS, so your federal return covers everything that you spend and everything that you make. It doesn't matter what state. It doesn't matter what country. If you're an American citizen. But state to state, yes, there are going to be different rules for businesses from state to state. Some states don't even have income tax. So you want to take that into consideration when you're expanding your business is, okay, if I move in Florida, I don't even have to worry about state income tax. But here in Michigan, the rate is 4.25%. Or do I want to go into California where I can be paying 10%? Or New York where I'm paying 11%, right? So there are different income tax levels from state to state. A lot of the information on your federal return, they use it to do your state return. But understand that a lot of the benefits that I talked about today, some of those benefits do not apply on the state level. So bonus depreciation and Section 179 do not apply on the state level. you're doing less than $300,000 in revenue for your corporation, you don't even fill out a state tax return in Michigan. So those are the type of things that you would have to have somebody that's going to look at each state for you and figure out this is what you're going to be paying in Illinois, this is what you're going to be paying in Ohio, this is what you're going to be paying in Indiana. Anything else? And you guys can talk to me after. I'll be sitting around for a little while. I really appreciate it, Dean. I really appreciate AAHOA for letting me come out today and talk to you guys. I hope this was beneficial.